Welcome, everyone, to another exciting episode of the YouTube show and podcast, None of Our Businesses, where we talk about this week's news, topics in business, tax, accounting, all of the above. We do it from the perspective of accountants, not just one accountant, but three accountants. I'm Tyee Carr. With me today is Tammy Hess.
Hi.
And Charlie Zigmond.
Hi, everybody.
And we're actually going to be talking about a lot of interesting things today. First, how to use rich person math to buy a gas station. And then avoiding small business bookkeeping mistakes. I'm going to give you a small business tax update on using the 100% meal deduction. We're going to talk about Elon Musk looking at solving world hunger. And finally, we're going to get another tax update related to the R&D credit requirements and why it's making tax pros angry. All right, everybody, let's kick this off today with Charlie.
All right, so I've got an article we can start off with from Kotaku.com called Twitch streamer Amouranth bought a gas station for negative 110,000 using rich person math. So what's happened is, there's a Twitch streamer and she's very popular, and she decided that it was a good financial move for her to go ahead and buy a $4 million gas station with $3 million of debt and putting the other $1 million up front. And she went to Twitter to go ahead and let everybody know just how smart of a move this was. And in explaining why, her logic is that she has gone ahead and received a $1.1 million tax deduction for doing this. And so in her eyes, that extra $110,000, which is the difference between her tax deduction and the price that she paid up front for this gas station, she's calling profit. And according to the article thinks she gives a pretty solid explanation of how this rich person math works. And its premise is basically that if you have enough money and credit, you can generate profit with really limited risk. And that was kind of the author's take on it. One of the big points that it mentions is that she's essentially getting an interest-free loan from the government in the amount of whatever the difference is. So the 110,000 that she would have paid in tax over what she paid down on the building. And so, just as I'm reading this, it's kind of an interesting article. I guess, my first question is spending $4 million to temporarily pay $1.1 million less in taxes, in your eyes, is that profit, or is she maybe underthinking that? And I guess more generally, if that is the case, should she stick to streaming, or what do you guys think?
Yeah, well, I mean, I guess the first question I want to know is, how did she get that loan, right? I guess she was highly qualified otherwise, and was considered a reasonable risk, because she didn't have to put much down for buying a small business like that. So that's quite the trick to get that loan. But I mean, I guess. So that would be the first barrier, right? For a lot of people, the entry barrier is qualifying for that kind of loan in the first place. But you qualify for that kind of loan, and she says there's no risk, but she has to pay the loan back at some point. So the business presumably has to operate. I mean, you're pumping gas, people buy gas. It's in hopefully a location where people are pulling over to buy gas. So maybe it's a no-brainer that the business generates the cash flow to pay that loan back. But I think that part is worth pointing out. I mean, it's kind of like it is like an expanded version of the classic real estate play, right? This is the same way that real estate tycoons are able to make money and use kind of the government tax deductions, the tax benefit piece of it, as well as basically using lending in order to own a lot of assets and earn a return on those assets. Because I think, to me, if the focus is on the tax benefit that she got, which you called out as a temporary tax benefit, but if the focus is on that, it's like she's ignoring the actual pre-tax, the pre-tax economic benefit of the cash flow from operating the business, and if there's real estate here, the appreciation and the value of the real estate over time as well, right? So that's, to me, kind of the real kind of permanent benefit is if there's appreciation in the real estate and there's cash flow from operating the business, that generates a permanent benefit, whereas the tax benefit is a temporary benefit. And if you ask, well, and directly to your question, is that a real profit? I would say, well, no, if it's temporary, right? And and we often see that with real estate type deals where real estate is not really declining in value in most cases, and yet there's depreciation deductions that are allowed for it. So that creates a temporary tax benefit that gets paid back. That tax benefit gets paid back if you ever sell the property. And so that's what would happen in the case of this gas station scenario, presumably, is that she would have to pay the tax benefit back many years in the future if she sold the property. So there is a benefit there, but it's the time value of money. It's not the 110,000. It is the inflation rate or the presumed interest rate that you otherwise would be charged to borrow $110,000. That's actually what she's getting from the tax benefit side of it. But yeah, it just seems like, to me, we're ignoring the rest of the actual benefits here, the business profits and the appreciation of the real estate.
I second that, Ty. And I think we're also forgetting the big part is of when she decides to sell it, the tax impacts that is going to have. And it's like with this kind of nifty little blurb that she put on and kind of promoted, and how smart she was of doing this and all this kind of stuff. It's like, are other people going to jump in and do this without really thinking through the full picture? And especially if they're able to even get those types of loans and things, or if by something happens during that year or so that businesses automatically, like, what if it goes down and then you're trying to pay off this loan and you don't have the money and you just took on this big risk and all this kind of stuff. So it was really interesting. I think it led me to have a lot more questions, not necessarily jump on and start doing this and be influenced by her nifty business idea.
Yeah, no, I think you guys hit it right on the head. And I think she's just looking at certain parts of it just to kind of shed some light on maybe why she was able to get the loan, whereas a lot of people wouldn't. The article talked about how there was somebody at that gas station who had called in one day and she was a friend of his or something. So she came down and worked there that day, and the place was just like packed with people coming up to filling gas because she like streamed it or whatever. And so I don't know that that's exactly what caused her to get the loan, but I think that's another move that a lot of people might not have when they're trying to go out and purchase their $4 million gas stations. All right, do you have another article we can talk about, Tammy?
I do. So I found an article from Accounting Today that I found a bit uplifting. So there's a lot of new businesses that were created in the United States. And according to Census Bureau, there are more than 4.4 million new businesses in 2020 alone. Looking in June of 2021, there were more than 448,000 businesses applications filed. So those, that are involved in these new businesses may be seeking some guidance as to what to do or what not to do when they're starting their new business venture. And this article provided some tips for new business owners to really consider. And I'll list them out here. But one was keep personal and business finance separate. 2, connect your accounting system to your business bank account. 3, keep records in a safe place, whether it be electronically or at least somewhere on site that you have access to them. 4, hire the right professional for your business. This article obviously focused on bookkeeping services, but I would venture to say that could include lawyers, tax professionals, and other type of professionals that you may use in your business. And 5, regularly review records and ensure things are being properly recorded and up to date. Don't wait until tax season to get it all sorted out. So as I was kind of going through this, I was thinking, this is a good list to start from, but do you guys have any other tips that the article missed, or things that people should be considering as they're, starting their new businesses?
I mean, I would say just being in the diligence of getting to the point that you're producing financial statements and looking at them, and whatever that means to you or how that process works out for you might be different for different owners. But I just think that taking the time to sit down and actually review that information regularly and putting it on the calendar is to me one of the big steps that I think just gets, pushed to the side a lot, because it always feels lofty. It never feels like important for that day, but I do think it's kind of the right thing to do. And I just just want to say the point about finding qualified professionals really resonated with me, as been in a lot of situations where trying to do something and just don't have that skill set. And then you bring somebody in who knows what they're doing on that task and they just blow it out of the water. And so I found that to be true in a lot of different areas of life. Accounting is one of them, but there's many others. And so that was my main takeaway.
Yeah, I think maybe I would take somewhat of a contrarian viewpoint about looking at the bookkeeping and hiring a professional, in the sense of, I think the reality of where we are today and where we're going today is that if you're starting a small business and at first, it's bootstrapped, if it's a micro business, it's not venture backed, you're not starting out of the gate with a lot of funding or anything. You have to be prepared as one of your skill sets to handle some of your own bookkeeping. And you have to be prepared to learn the technology that's available, whether it's a QuickBooks or whatever, to do some of the basics on that. And here's why I say that. As somebody who sells those kind of services to the companies that are in the right zone, it might sound funny for me to say that, but here's why I say that is because, there was a things that I read, I can't remember if it was one article or multiple articles or whatever, several years ago, that made an interesting point about the march of technology and what it's done to us as a society. And one of the things that really registered with me that I think is absolutely true is that as technology is advanced, what it does for us as consumers is it puts more onerous back on the consumer. So what technology does is it basically takes away, what it generally does is it takes away the need for service providers and puts work back on the consumers who use technology. And I think that's exactly what we see happen when it comes to kind of very small micro business bookkeeping type work. Because what happens, let's suppose that you're somebody who's really great at selling, you're really great at marketing, you're really great at your ideas, and you really just don't want to touch the books. You don't want to touch any kind of bookkeeping at all, right? The reality is that the software vendors like Intuit, who create QuickBooks and things like that, they have banked on the idea that you're a rare bird, and they've banked on that idea in the sense that they have made their software, they have pushed hard to make their software accessible to a large portion of the entrepreneurial community who is capable, willing, and wanting to kind of do some of their own work when they're that micro business. And what that's done is it's forced out of the market small bookkeepers. So, when people ask me, is there a bookkeeper who works with really micro businesses that you would recommend? I have to kind of shake my head and say, no, there really isn't, because I don't find a lot of qualified, really small end bookkeepers, because it's not a good business to be in. And for that reason, we don't see a lot of like highly qualified people doing that kind of work. And because of the market that would need that kind of work, the software platforms have driven out the quality producers, right? Like we can't find enough clients in that zone and make enough money to make that a viable business for the qualified quality people that are in our firm, for example, right? And I think that's true kind of at scale market wide for the most part. And so because the software platforms have driven out the kind of the providers, because you've got a large chunk of operators who kind of have figured out how to do it on their own cheaply. When you're that rare bird who's like, hey, I'm a genius at selling and I've got my business, but I want somebody else to handle the books, there's no one there to help you, because the market has basically been gutted by this whole process. And I think that is it's not just our industry. It's not just the industry of bookkeeping or anything else. Across the board, that's what technology does to industries, is it guts those industries such that the people who still may want that help are essentially now asking for what is otherwise a kind of a luxury service. It's like, 80 to 90% of the entrepreneurs are going to just figure out how to do this on their own with QuickBooks or Xero or whatever platform until they get large enough that it's too complex for them to do on their own. And then they're going to hire people. So if you're in that 10 to 20% that, really would value having somebody do it, hey, I love you. And you're the ones we would want to serve. But the reality is that is that the market has made it so that you're basically asking for a luxury service now, and that's going to require that you pay kind of an excised fee for that, because there aren't enough providers that actually do that at scale and with quality.
Yeah, and I think the thing that the article missed and on that is that they didn't really kind of give any guidance as to when do you do that? Like, when do you decide to go ahead and start utilizing professionals or an outsourced accounting, or trying to tap into that versus learning the skill sets and doing on your own for a certain period of time? Because I think it fluctuates, right? It depends on the complexity, it depends on how fast it grows and all those things. But I think that is some guidance that new owners could do, because there are a lot of tools out there to utilize for the accounting records to make sure that you are doing at least most of the steps in the 1 to 5 about keeping your records in order and making sure that you separate business from personal, so it's easier to manage that business. But I wonder if there is kind of a rule of thumb in terms of when should you start considering looking to outsourcing that, or getting some professional help with that.
Yeah, and I think oh, sorry, Charlie, go ahead.
No, go ahead. Sorry.
Well, I was just going to double down a little bit on my point and just say, if I'm advising kind of a new operator or entrepreneur, I'd say doing some basic bookkeeping should be in your skill set. Like if you're kind of wanting to start a business and you're like, I want to start a business, but I'm completely incapable of doing any of the managing the technology or doing the math involved with some basic bookkeeping. In today's environment, that's going to be a hard road for you to be starting a business, and you're probably that may not be the right path for you, period, at that point.
Well, and just to kind of build on that point, because I'm kind of thinking in that same line, perhaps there's a compromise to be had in terms of, if you're in that space, maybe what you need is somebody to come teach you how to do the parts that you would otherwise have them do, and then insert yourself or somebody else to actually implement them. But perhaps what you're missing is just knowledge that can be shared and then worked into a process. And I think that doesn't work for everybody, depending on what their challenges are. But I think there are a subset of clients who are fit into that category and could, stand to benefit from somebody teaching them that, but not necessarily doing it for them after they've been taught.
Great point. I love that. Yeah. Don't try to look for somebody who's going to just do it for you, because you're not in the zone for that. But look for somebody who can teach you what you need to do so that you can do it. And you've got to have the aptitude for being able to do that if you're going to start up and operate a micro business.
That's great. Well, good. And it's exciting to see that there's new businesses out there, and there are more coming every day. So it'll be, I'm sure, helpful for folks. I think, Tyee, you have our next article.
Yeah. So this is, I don't know that this will elicit a lot of discussion from the crew here. It's more of just kind of an update, a tax update for our small business community out there. So we've talked about it before here on the show, but for those of you who don't know, there is currently a 100% meals deduction. So if you are incurring meals in a business setting and you're incurring those at what is considered a restaurant, and in a prior podcast, we've talked a little bit about how that was defined, how they were defining what is considered a restaurant. But if you do that, you are able to deduct 100% of the cost. And that is a benefit that is more than what historically the benefit has been. It used to be that meals were only deductible 50%, but business meals would only have been deductible 50% at restaurants. And this 100% deduction for meals at restaurants in part was to inspire people to get back out there and patronize restaurants, so that we could that part of the economy could be sustained, right? So that was certainly an obvious reason for why this was put temporarily into the tax code. Well, the update for you here is that some of our small businesses out there might use what's called a per diem method for employees. That is, that typically one way that you might have employees, like if you have sales employees who are incurring travel costs and meal costs, and they're going to restaurants, it may be that they submit their receipts to you and you reimburse them. And if that were the case, and they were submitting receipts to your business and you reimbursed them for the cost of a restaurant, then you would naturally, that this 100% business meal deduction would apply in that context. And that's probably how you would think it applies, right? Well, there's a different scenario where some small businesses are not actually reimbursing their employees or their teams based on actual receipts. They're reimbursing them based on a per diem method, where the IRS publishes a per diem for locations that people might be in, and you are allowed to provide that per diem to and provide that employee with that per diem amount. And as opposed to getting the actual receipts, you don't have to justify it with the specific costs and the receipts in order to claim that as a valid deduction, and for the employee to not have to claim it as income is the other piece of that, right? But all of that's to say, well, that could be how you're essentially your reimbursement plan for employees. And it raised the question, well, if you're just paying employees a per diem and they're not actually providing you with proof that they went to a restaurant, do you get 100% tax deduction for the meal portion of that? And the reason, because historically, the meal portion of the per diem would only be 50% deductible under the way the law previously worked. So the announcement here, you're hearing it here. The announcement is that this has been clarified that you can in fact take the 100% deduction as a business for the meal portion of the per diem that you provide to employees, so that regardless of how you're reimbursing employees for the meals, you as a business, you still get to apply that 100% deduction for meals. So that's a great benefit. And yeah, just wanted to make sure our audience knew about it.
So what you're saying is that everyone should structure their compensation to max out per diem first, as well wherever they can. It's tax free to everybody. It's a good thing. And then, for everything after that.
Yeah, absolutely. But, there's some of us who have charge accounts that are higher than the IRS published per diem. So that wouldn't work. If you're one of those high rollers, don't think you're going to take advantage of Charlie's plan there.
I just want to say, I think it's good because I've always thought that the IRS deduction of 50% for meals was questionable at best. I think that ultimately, if you want to call it compensation, treat it as a fringe benefit and make it taxable or something like that. But I mean, ultimately, if the company is spending it and if it's within the boundaries of what they're doing, if it's somehow a part of their operations, it feels like that should be 100% deductible, or at least that's my personal opinion. What do you think, Tammy?
I think that that's true. The only challenge that I have with it is that per diems aren't always used, right? So you could be getting $100 per day per diem, for example, and yes, you probably have hotel expense that is actually applying towards or things of that nature. But you may not go out to eat. You may not eat at all, or you may eat, very, very minimally. That's lower than that per diem amount, and so it still makes sense why it's all there, but at the same time, I'm not sure if it's reaching the goal, which was to encourage people to go out and eat at restaurants and really help the restaurant industry, when at the end of the day, you're getting the benefit, the tax benefit, but how you choose to use that per diem is really up to the person. And so I have a little bit of a pause on that, just because I've been in the place where I chose not to elect to use per diems for paying folks, because it's almost like, I want you to go ahead and eat well and do all this stuff. So go ahead and send me your receipt and I'll reimburse you for the full amount, because sometimes per diems don't work that way. That's just my 2 cents. So Charlie, I think you have the next article.
Sure. Yeah, I've got one that I think fits right in with what we're talking about now. So if per diem doesn't solve your hunger, I'll tell you what can. CNN says that Elon Musk should sell Tesla stock right now, and that would produce $6 billion, and he can use that $6 billion to solve world hunger. And now CNN's reporting on it, but it was one of the United Nations directors who really called him out on this. And Elon replied, if WFP can describe on this Twitter thread exactly how $6 billion will solve world hunger, I will sell Tesla stock right now and do it, but it must be open source accounting so that the public sees precisely how the money is spent. And so I started looking into this. The article uses an input of 42 million people as those who are hungry, which I thought was a little interesting, because I mean, if we have 7.7 billion people in the world, how is it only 42 million that are considered to be in hunger? But if that is the input, then that works out to about $143 a person. And so as much as I think that we should solve world hunger, and I, so on and so forth. But it's like, I kind of got to agree with Elon in the sense that I don't believe that $143 is enough to solve hunger for anyone. And it seems to me like that this issue is not a one-time cost sort of fix. It's not a thing of like, let's just plug in some money here and then that will solve this issue forever. And he kind of admits that. He says, the director who called out Elon says, well, it's not going to solve world hunger, but it's going to prevent geopolitical instability, mass migration, and save 42 million people on the brink of starvation, an unprecedented crisis and a perfect storm due to COVID and conflict and climate crises. And so I just thought it was kind of an interesting premise. I guess my questions would be, do you believe that 6 billion could solve world hunger? Should Elon Musk be the one to do that? Or is this all just really a facade for being upset at rich people? What do you guys think?
Well, I think that what it inspires is the conversation, because I don't think it's an easy fix, because if it was just assign a dollar amount to it, which is, I think you said 143 per person, then, and that would fix it going forward. We probably could have done that a long time ago. I think that the truth of the matter is that it's not a one-time money funding source. It's a long-term kind of plan of how do we actually solve it, and it's solved going forward. And so while this article is interesting and it kind of points, it has a couple of I think quips between two of the folks, but it really doesn't quite, it just inspires the conversation of what can we do? What should we do? It's not just one person. It's not just Elon and trying to do it all on his own. It's a combination, but we need to probably work together to figure out how do you solve that. And it's not easy. I mean, I think that's what we have all can agree on.
Yeah, I think that is, I agree with this whole point, is that I don't believe that these problems, world hunger and others that are kind of similar or related, are really a matter of not enough resources. They're a matter of distribution and systems and things of that nature. And I think that's what Elon Musk believes. And I think that this was his kind of ornery way of making opening that debate and and making that point. And so yeah, it'd be interesting to see where it continues, where if this has legs, where it continues to go, and how this conversation, like Tammy said, it's created the conversation, which is clever and interesting. And yeah, I'll continue to be interested to see where it goes.
All right. Do you have another article we can talk about, Tammy?
I do. All right. So, in keeping in line with kind of some tax updates, back in September, the IRS established new rules for R&D tax credits. And the rules are causing some angst amongst tax professionals. Why? Well, the new rules will require an increased level of detailed information on all of the company's research activities in order for them to claim the tax credit, which may discourage businesses from seeking R&D credits in the first place. Some tax professionals believe that the level of scrutiny during an exam is already intimidating to most, and adding more requirements and in a certain canned way is going to be extremely frustrating for the tax preparer. From what I read, the biggest concern is having the information available and in more detail at the time of filing, rather than if selected for an exam. Many people fear that there's not enough time or resources to get everything in place before filing for the credit. What I find interesting is that the IRS had listed improper claims for the R&D tax credits as its dirty dozen tax scams. And there's a kind of a link that these new rules are going to hopefully aim to combat that. So I wanted to kind of discuss here is, do we think that the angst that people are feeling is kind of validated? Do you think that this asking for more information in the detailed way up front in terms of prior or when filing versus if selected by an audit is actually going to help these dirty little tax scams that were apparently or allegedly occurring?
I mean, I think that anything that leads to better documentation is a good thing, and so I think them pushing for more documentation, that want, I do think is good, and that people who are claiming this credit should have their ducks in a row to be able to do that. So in general, I am kind of with the sentiment of that. The flip side of that would be that I think it depends on how clear it is to the business operator what is actually being asked of him. If it's the case that there's a clear, basically a layout that he can use to then gather all this research and information and then easily provide that to the IRS, then I think that could make sense. If it's the case that what the IRS wants is very cryptic and requires a lot of industry knowledge, and most operators aren't going to have it, and they're just going to use this as an easy way to reject credits by giving these boilerplate requirements that no one can meet, that's not quite the same. So to me, it really just depends on the implementation. But I do think that I can definitely foresee this causing a lot of challenges for people who have maybe claimed the credit and didn't organize their workings exactly the way that the IRS would have wanted them to.
Yeah, I mean, this comes in an environment where we just went through the employee retention credit, and I think I think where the IRS is at with this, is that there's a lot of these boutique operations that have sprung up in the last few years, and it's been going on for a while, where they're just going around and helping companies claim credits, and they're not necessary. Yeah, and the quality of the work that's being done to determine whether the company actually qualifies under the law, and whether they're actually applying the law correctly to claim the credit when it comes to the research credit, is really all over the board. And so, I just see the volume of these services, and I've worked in and around some, and they've been pretty good, the ones that I've worked with. But when I see as many as are kind of coming up and constantly pinging me and other people in finance and accounting and business owners about, hey, let us help you get your research credits, you have to imagine that there's a lot out there that's just not really doing good work. And I mentioned the employee retention credit because that was starting to happen. That was happening with the research credit before the ERC. Then the ERC came in, and it was like on steroids. You had all these like boutique operations popping up to help people claim their ERC, which was like, it looked like cookie cutter template. This is the same pitch that they make for the research credit, and they've just kind of changed a few words to make the pitch for the ERC. And so I think that's the environment that this is coming out in. And so it's not shocking to me that the IRS would be making this push in some way. And it is most likely, with the kind of Biden plan of upping the resources that the IRS has available as a way to generate more revenue for the Treasury, the research credit is one of those areas where it is likely that there is a lot of low-hanging fruit out there in terms of companies who have claimed credit that they're not really entitled to, or by, maybe again through no fault of their own, just because they got kind of shoddy advice. I think what's interesting is kind of thinking about, tax professionals who aren't for this, because it might have, to what Charlie was talking about, I think the ideal scenario, if I were on the regulatory side of this, what I would love to see, and maybe it's self-serving of me to say it this way, but what I'd love to see is that companies work with their advisors who really know their business well, so that they're really working deeply with the same folks who prepare their tax returns year in and year out, or other kinds of advisors that financial and advisors that have tax knowledge that they could be working with, but that have relationships with the company. I think those who have advisors who have a long-term stake in the company and in a relationship with that company that goes beyond just computing the credit for them are probably going to be more thoughtful. And first off, they're going to bring more embedded institutional knowledge about the company to bear in coming up with the credits, but they're also going to be more thoughtful and and more risk adverse to just kind of throwing things out there. The irony, though, is, and I think this speaks to kind of what Charlie was getting at, is if the IRS is making really kinds of complicated and obscure documentation rules that your average kind of tax advisor is not really going to know because it's too detailed and too too particular for them to get into, it kind of creates and breeds these specialty firms, right? Because it creates a need for a specialist. It creates a need for people who are really just focused on just doing that so that they can navigate these IRS rules. And so I think it has the perverse possibility of creating the opposite effect of what you would want, in the sense that it's going to create a boutique industry of firms that specialize in how to apply the IRS rules to still kind of get the result. And yeah, it's rules, just kind of focusing on rules rather than on holistically whether you're getting to the right answer or not, is always problematic. But what do you do? I mean, I don't know that I have a better answer for them. I mean, so yeah, those are all my crazy thoughts.
No, and I think those are good points, Ty, because if you think about it, what the challenge is that a lot of people were taking tax or credit R&D claims that weren't necessarily R&D, or they didn't have the right documentation to say this is exactly how I came up with the wages, or this is how I came up with certain things. So, but the IRS point of view probably was like, in order to come up with those calculations of what credit you were trying to apply for or obtain, you should have already that should have been your source of information. So instead of going and saying, and I think the other part too is that finding those out via an exam is time consuming, and you don't always capture everything because the IRS didn't have an army of teams just going out and examining all these R&D credits. So I think what the attempt was to get the information done in advance so that people are using the right calculation and can support their calculations up front. And that seems reasonable. But to your point, if it's way too detailed or way too complex that the person can't necessarily get to that information, then that does bear the question of how our company's going to do this, and in the timing that that it takes, because now it's in place. And so if there was this time in order to do it, they're going to either have to get some help in there quickly or use a specialist and try to get that in there as well. But at least I think my message, I guess, for folks is to, especially if you already, have been in the habit of utilizing the R&D credits, really look at it early this year to make sure that you have the stuff in place and the right calculations and have those discussions up front versus trying to scramble at the end and miss the opportunity to do it.
All right, everybody, that's been our show. Thanks for watching. Thanks for listening. Please tune in again next week for more business updates from an accountant's perspective. And please check out our sister podcast, Profitless on Purpose, on this same channel, where they discuss anything and everything relating to the nonprofit space. Thanks, everybody.
Bye.